The role of a life agent in assessing a client's needs. A life insurance agent's primary role is to help clients determine the right type and amount of life insurance for their specific situation. This process, known as a life insurance needs analysis, involves assessing several key areas of the client's life to quantify their insurance needs. The role of a current spouse. When a person is married, they often want to ensure their spouse receives financial assistance if they die. The level of support needed depends on whether the surviving spouse is financially dependent or self-sufficient. Dependent spouse. In single-income households, the death of the primary earner would be devastating to a spouse who has no income or limited job prospects. The needs analysis must consider the loss of income and potential future costs like childcare if the surviving spouse needs to return to work. Self-sufficient spouse. In dual-income households, the surviving spouse may be partially or fully self-sufficient. Case study: Derek and Becky's family. Derek, 47, is the vice president of industrial design, with a take-home income of $8,400 per month. Becky, 38, is a stay-at-home mother to their 3 children: Jordan, 8, Anya, 4, and Robbie, 2 months. She plans to return to work as an HR manager in about 6 years with an anticipated take-home pay of around $4,500 per month. Derek wants to ensure that Becky doesn't have to return to work until Robbie is 18, if at all. If he were to die, Becky's potential income alone wouldn't be enough to maintain their current lifestyle. Support obligations to ex-spouse. A client may have a legal or moral obligation to provide financial support to a former spouse. Court-ordered spousal support may require the client to maintain life insurance with the ex-spouse as the beneficiary. Case study: Derek wants to ensure his ex-wife, Susan, continues to receive the $500 in monthly spousal support even if he dies. Minor children. A person with dependent minor children will want to ensure they are well cared for if they die. This often means providing enough funds for them to maintain their standard of living through adulthood, and sometimes through post-secondary education. The needs analysis should also account for the financial impact of a stay-at-home parent's death, which can be significant, particularly with young children. Child support to ex-spouse. If a client has children from a previous relationship, they may have a legal obligation to provide child support. Court orders may require the client to have life insurance to cover this obligation. Case study: Derek has a divorce agreement to pay Susan $1,000 per month in child support for Jordan until he turns 19. He wants to ensure this support continues even if he dies. Other dependents. Other dependents could include disabled family members who need lifelong care or aging parents for whom the client provides physical or financial support. Assessing employment and income. Loss of income is a major financial risk associated with death, so an agent must understand the client's income stream. For employees, current income. The needs analysis is based on the client's take-home pay, income after taxes, and other deductions. As this is the spending power the family would lose, the surviving spouse's income is also considered as a continuing source of funds. Future income potential. Future income, including expected raises or promotions, should be factored in to ensure the family can maintain their anticipated standard of living. Job stability. The stability of both the client's and their spouse's jobs should be assessed. If a client's job is at risk, they may benefit from a policy that allows for temporary premium reductions. If the spouse's job is at risk, the needs analysis should account for greater financial dependency. Group benefits. The analysis must account for the loss of group benefits, such as medical, dental, and life insurance, which cease when an employee dies. Case study: Derek's take-home pay is $8,400 per month, and he expects to be promoted to COO within 2 years, which would increase his take-home pay to $9,500. Becky is concerned that her outdated technology skills will make it difficult to find a job after being a stay-at-home mom, making the replacement of Derek's income even more crucial. For business owners, an agent must understand the business structure, sole proprietorship, partnership, or corporation, as it affects the amount and type of insurance needed. Sole proprietorship. The business owner reports net income on their personal tax return. If the owner dies, the business typically ceases to exist, and their family loses that income. Corporation. An owner may receive both employment income and taxable dividends. A corporation can continue after the owner's death, but the deemed disposition of shares can trigger a large capital gains tax liability for the estate, even with the lifetime capital gains exemption, LCGE. Partnership. A partner's share of income is reported on their personal tax return. The deemed disposition of their partnership interest can also result in a significant capital gains tax. Buy-sell agreement. A buy-sell agreement is a contract that dictates what happens to a business interest when an owner dies. It often requires the use of life insurance to fund the purchase of the deceased owner's share by the remaining partners or the corporation. Assessing current financial situation. The needs analysis requires a clear picture of the client's finances, including assets, debts, income, expenses, and cash flow. Assets. Liquid assets. These are assets that can be easily converted to cash, such as bank accounts and term deposits. They are crucial for paying final expenses and taxes and covering debts after death. Fixed assets. These are tangible properties that could be sold, such as real estate, vehicles, or valuables. Investment assets. These include stocks, bonds, mutual funds, and other investments. The fair market value, FMV, and adjusted cost base, ACB, of these assets are important because a deemed disposition upon death can trigger a tax liability. Debts. Debts, like mortgages, credit card balances, and loans, can limit cash flow and may need to be paid off after death. Case study. Derek and Becky have a mortgage of $309,912, and Derek has a car loan with a balance of $41,000. Derek wants these debts paid off if he dies. Tax liability. Death can trigger a tax liability from the deemed disposition of capital assets and registered plans. For example, if Derek leaves his cottage to his children, it could result in a taxable capital gain. Current expenses. The analysis should consider the family's current expenses and how they would change after the client's death. Assessing existing insurance and government benefits, the life agent needs to identify and evaluate all existing insurance policies and potential government benefits. Individual insurance. The agent should review the policy type, death benefit amount, cash surrender value, policy ownership, beneficiaries, and any riders or limitations. Case study. Derek has a 10-year term policy for $250,000, which he bought at age 39. The policy is renewable and convertible to age 70. Business insurance. If the client is a business owner or key person, their life may be insured for business purposes. The death benefit from this policy may not be available to the client's family. Group insurance, group life insurance, often provided through an employer, should also be assessed. It's important to understand the coverage amount, policyholder, and conversion options. As group coverage often ends upon retirement or termination of membership, group coverage has vulnerabilities, such as limited amounts and no member control over the policy. Government benefits. Government benefits like the Canada Pension Plan, CPP, and Quebec Pension Plan, QPP, offer survivor benefits, including a death benefit, survivor's pension, and a children's benefit. However, these benefits are not automatic and may not be sufficient to meet all of a family's needs. Workers' compensation, WC, benefits are only available if death is work-related. Identifying the client's priorities. Beyond the numbers, the agent must understand the client's qualitative priorities for their family. Family lifestyle. This includes questions about childcare, the surviving spouse's financial dependency, the family residence, and heirloom properties. Final expenses. The client's wishes for their funeral should be discussed to ensure funds are available to cover these costs. Future plans. Many clients want to plan beyond immediate needs and consider future expenses such as post-secondary education, weddings, and charitable donations. Case study. Derek wants Becky to be able to stay home with the children and wants to ensure their debts are paid off. He also wants to secure the financial resources for his children's post-secondary education and for a $100,000 charitable donation to a local hospice. He estimates final expenses to be around $20,000.